1. Stocks. Stocks are like tiny pieces of ownership in a company. When you buy a stock, you're not just getting a piece of paper, you're becoming a part owner of that business. It's like joining a massive team where everyone chips in money to help the company grow. The beauty of stocks is that they can grow in value over time. As the company becomes more successful, more people want to own a piece of it, driving up the stock price. It's like watching a tree grow from a small sapling into a mighty oak. But stocks aren't just about price growth. Many companies share their profits with stockholders through dividends. It's like getting a slice of the company's success pie regularly. However, stocks can be risky. Companies can face tough times, and stock prices can fall. It's a bit like riding a roller coaster. There are ups and downs, and sometimes it can be scary. But historically, over long periods, stocks have tended to go up more than down. Investing in stocks isn't just about making money, it's about believing in innovation, progress, and the power of human ingenuity to create value. Click subscribe to this channel to get more topics you love. 2. Bonds. Bonds are like IOUs from big organizations. When you buy a bond, you're essentially lending money to a government or company. In return, they promise to pay you back with interest. It's like being a mini bank, but instead of lending to individuals, you're lending to entire nations or corporations. The beauty of bonds lies in their predictability. Unlike stocks, which can be as unpredictable as the weather, bonds offer a steady stream of income. It's like planting a fruit tree that yields a consistent harvest every season. However, this stability comes at a cost. Bonds typically offer lower returns than stocks over the long term. It's a trade-off between safety and growth potential, like choosing between a slow but steady tortoise and a speedy but unpredictable hare. Bonds play a crucial role in diversification. They can act as a cushion in your investment portfolio, softening the blow when stock markets tumble. It's like having a safety net while walking a financial tightrope. Understanding bonds is key to grasping the pulse of the economy. Interest rates, inflation expectations, and economic health all influence bond prices. It's like having a financial crystal ball, offering insights into the broader economic landscape. 3. Mutual funds. Mutual funds are like investment carpools. Instead of going it alone, you join forces with other investors, pooling your money together. This collective pot is then managed by financial experts who use it to buy a mix of stocks, bonds, or other assets. The beauty of mutual funds lies in their simplicity and accessibility. They offer instant diversification. It's like buying a pre-packaged garden instead of picking individual plants. Even with a small amount of money, you can own a slice of hundreds of companies or bonds. Mutual funds come in many flavors. Some focus on specific sectors like technology or healthcare, others on geographical regions, and some aim to mirror entire markets. It's like having a buffet of investment options to choose from. However, mutual funds aren't free. They charge fees for their management, which can eat into your returns over time. It's a bit like paying for a tour guide. You get expertise, but it comes at a cost. Despite this, mutual funds remain a cornerstone of many investment portfolios. They offer a balance of professional management, diversification, and accessibility that's hard to beat for the average investor. 4. Exchange-traded funds, ETFs. ETFs are like the nimble cousins of mutual funds. They're baskets of securities that trade on stock exchanges, just like individual stocks. Imagine a chameleon that can change its color. ETFs blend the diversification of mutual funds with the trading flexibility of stocks. The magic of ETFs lies in their efficiency. They often have lower fees than mutual funds because many track indexes passively, rather than being actively managed. It's like having a self-driving car for your investments. It follows a preset route without the need for constant human intervention. ETFs offer incredible variety. You can invest in broad market indexes, specific sectors, commodities, or even investment strategies. It's like having a Swiss Army knife for your portfolio. There's an ETF for almost every investment need. One of the most powerful features of ETFs is their transparency. Unlike mutual funds, which only disclose their holdings periodically, most ETFs let you see exactly what's in the basket at any time. It's like having X-ray vision for your investments. However, the ease of trading ETFs can be a double-edged sword. The ability to buy and sell quickly might tempt some investors into overtrading, potentially harming long-term returns. It's important to remember that just because you can trade frequently doesn't mean you should. 5. Savings accounts. A savings account is like a financial home base for your money. It's a secure place where you can store your cash and earn a little interest along the way. Think of it as a piggy bank that grows on its own, albeit slowly. The primary advantage of a savings account is its liquidity. You can access your money whenever you need it. It's like having a financial safety net always ready to catch you. This makes savings accounts ideal for emergency funds or short-term savings goals. However, the interest rates on savings accounts are typically low, especially when compared to other investment options. It's a trade-off between accessibility and growth. Your money is safe and available, but it's not working as hard as it could be. Many banks now offer high-yield savings accounts, which provide better interest rates than traditional accounts. It's like upgrading from a regular piggy bank to one that feeds itself a little more generously. Despite their limitations, savings accounts remain a cornerstone of personal finance. They're often the first step in a person's financial journey, teaching valuable lessons about saving and financial responsibility. 6. Checking accounts. A checking account is like the command center of your personal finances. It's where most people manage their day-to-day money, handling everything from receiving paychecks to paying bills. The key feature of a checking account is its transactional nature. You can easily move money in and out through various methods: checks, debit cards, electronic transfers, and more. It's like having a financial Swiss Army knife always at your disposal. Unlike savings accounts, checking accounts typically don't earn much, if any, interest. The trade-off here is between utility and growth. Your money is incredibly accessible, but it's not there to grow, it's there to be used. Modern checking accounts often come with a host of digital features, mobile apps, online bill pay, and instant alerts. It's like having a personal financial assistant in your pocket, helping you stay on top of your money 24/7. While not glamorous, a well-managed checking account is crucial for financial health. It's the foundation upon which more complex financial strategies are built, teaching invaluable lessons about cash flow management. 7. Money market accounts. A money market account is like a hybrid financial vehicle, combining features of both savings and checking accounts. It typically offers higher interest rates than a regular savings account, but with some check-writing privileges and debit card access. The appeal of money market accounts lies in their balance of liquidity and yield. They provide a place to park larger sums of money that you might need in the near future, offering better growth than a checking account but easier access than a CD. It's like having a financial stepping stone between your everyday cash and your long-term investments. However, money market accounts often come with higher minimum balance requirements and may limit the number of transactions you can make each month. It's a trade-off between better returns and some restrictions on use. These accounts are particularly useful for specific financial goals, perhaps saving for a down payment on a house or building up an emergency fund. They provide a safe harbor for your money while still allowing it to grow modestly. It's important to note that money market accounts are different from money market funds, which are a type of mutual fund. While both aim for stability and modest returns, money market accounts are FDIC insured, providing an extra layer of safety. 8. Treasury Bills. Treasury bills, often called T-bills, are like short-term loans to the U.S. government. They're considered one of the safest investments available because they're backed by the full faith and credit of the United States. T-bills are sold at a discount from their face value and then mature to that full value. For example, you might buy a $1,000 T-bill for $990 and receive $1,000 when it matures. The difference is your interest earned. It's like buying a promise from the government at a discount. These bills come in various short-term maturities, typically 4, 8, 13, 26, or 52 weeks. This makes them ideal for investors who need liquidity but want a bit more return than a savings account might offer. One of the unique aspects of T-bills is that they're exempt from state and local taxes, which can make them particularly attractive in high-tax areas. It's like getting a double benefit: safe investment and tax advantages. T-bills play a crucial role in the broader financial system. Their yields often serve as a benchmark for other short-term interest rates. Understanding T-bills can give you insights into market expectations about the economy and interest rates. 9. Corporate bonds. Corporate bonds are like financial bridges between companies and investors. When a corporation needs to raise capital, it can issue bonds, essentially borrowing money from investors with a promise to pay it back with interest. The appeal of corporate bonds lies in their potential to offer higher yields than government bonds. This higher return comes with increased risk. Unlike government bonds, corporate bonds carry the risk of default if the company faces financial troubles. It's a balancing act between reward and risk. Corporate bonds come in various flavors and maturities. Some are short-term, others extend for decades. They can be rated by agencies like Moody's or S&P, giving investors an idea of the company's creditworthiness. It's like a financial report card for the company's ability to repay its debts. One interesting aspect of corporate bonds is their inverse relationship with interest rates. When rates rise, existing bond prices typically fall, and vice versa. This makes them a tool for interest rate speculation as well as income generation. For many investors, corporate bonds serve as a middle ground between the safety of government bonds and the volatility of stocks. They're a key component in diversifying a portfolio and managing overall investment risk. 10. Municipal bonds. Municipal bonds, often called munis, are like community investment tools. They're issued by state and local governments to fund public projects like roads, schools, and hospitals. When you buy a muni, you're essentially lending money to your community. The standout feature of municipal bonds is their tax advantages. The interest earned is often exempt from federal taxes, and if you buy bonds issued in your state, it may also be exempt from state and local taxes. It's like getting a double or triple tax break on your investment income. Munis typically offer lower yields than corporate bonds, but their after-tax return can be competitive due to the tax benefits. This makes them particularly attractive to investors in higher tax brackets looking for tax-efficient income. These bonds come in two main types: general obligation bonds, backed by the full faith and credit of the issuer, and revenue bonds, backed by income from a specific project. Understanding the difference is key to assessing the risk of each bond. Beyond financial returns, municipal bonds offer a way to invest in your community's future. They provide a tangible connection between your investment and local development, making them a tool for both financial and social returns. 11. Mortgage-backed securities. Mortgage-backed securities, MBS, are like financial alchemy, transforming individual home loans into tradable investment products. Banks bundle together many mortgages and sell them as a single security, allowing investors to earn income from the mortgage payments made by homeowners. The appeal of MBS lies in their ability to offer steady cash flow and potentially higher yields than government bonds. They also provide a way to invest in the real estate market without directly owning property. It's like getting a slice of the housing market pie without the hassles of being a landlord. However, MBS come with unique risks. If many homeowners default on their mortgages or refinance when interest rates drop, it can affect the return on these securities. The complexity of MBS also makes them challenging for individual investors to analyze thoroughly. MBS played a central role in the 2008 financial crisis, highlighting both their importance in the financial system and the potential risks when they're not properly understood or regulated. This history serves as a stark reminder of the need for due diligence in complex financial products. Despite their complexities, MBS remain a significant part of the investment landscape, particularly for institutional investors. They offer a unique way to gain exposure to the housing market and can be a valuable tool for portfolio diversification.